If you've heard the term SPAC in the last year, you might be a little confused. Is it a hip new slang term the kids are using to refer to spackle? Or perhaps it's Spock from Star Trek's brother that we've never heard about until now? Or, and this is probably the right answer, it's something called a special purpose acquisition company. But what does that even mean? In 2021 so far, SPACs have raised more than $83.4 billion, which was the record set in all of last year. That's an insane amount of money for companies, so what do they even do? Well, nothing. SPACs are companies as much as I'm the next CEO of Tesla. That's maybe being a little bit harsh, but SPACs are blank check companies. They have no business plan for how to make money or sell products other than to merge with another company that's already making money. So why would a company that's already making money want to merge with a SPAC, an otherwise useless business? Because SPACs are listed on stock exchanges already, something that a private company looking to take their stock public might be looking to do. It's the asset of already being publicly traded and listed that makes SPACs valuable in the business world. When a SPAC is created, they typically list themselves in a stock exchange, like the New York Stock Exchange, and then they have 24 months to acquire another company. If they don't succeed in doing this, then the SPAC has to dissolve and return all of its money to the stockholder. Basically, SPACs are companies that are given a bunch of money by investors to go out and merge with another profitable company as quickly as possible, in hopes that that merger will reward the investors with a higher stock price down the line. One of the most recent examples of a high-profile SPAC merger was that of Virgin Galactic, Richard Branson's space company. They began trading under the ticker SPCE in 2019 after merging with a company called Social Capital Hedosofia, which was a SPAC. So why would a company choose one SPAC over another to go public? That mostly has to do with connections and popularity. The founders of otherwise useless SPACs are generally the main draw. If the founders are high-profile investors with great connections, their SPAC is likely in for more success than if you just went out and started a SPAC today. There are a rising number of SPACs that have been listed on the stock market in the last several years. But why? Why would a company merge with a SPAC to go public rather than just going public on the market themselves? Mostly because it's easier to merge with companies than it is to get listed on an exchange. Going through an initial public offering or IPO for a company is time and cost sensitive, requiring a lot of help from investment banks and roughly 2 to 3 years to close the deal. Merging with a SPAC, though, only takes 2 to 3 months. For a rapidly growing startup looking to get their shares on the market, merging with a SPAC seems pretty attractive. In recent years, the regulatory hurdles of listing a company on the stock market have grown, so SPACs have come in to solve that problem. The founders of SPACs can simply focus on listing the company, and once they've done that, the company, that otherwise doesn't make money, is valuable to other companies simply because it's already listed. A good way to think of SPACs is that they're luxury cars you have to build yourself. You may want to drive a luxury car, but don't want to put in the time, money, or effort that it takes to build one. So you might look around for luxury cars already on the market that you could hop into and drive away. By merging with a SPAC, the private company gains quick and easy public listing, allowing executive and company capital to remain focused on their core business. For the SPAC and their investors, they get in on the ground floor of what is hopefully a successful company. It's like getting the chance to buy into a company before they even go public. So SPACs are companies that have one asset, the fact that they're traded on an exchange already. Private companies looking to go public might want to merge with a SPAC to make the listing process as easy as possible. At the end of the day, SPACs are just companies filling a need that emerged in the market, as weird and niche as that need may be.